What is Liquiloans? Liquiloans is an online peer-to-peer lending platform that leverages new-age technology to match creditworthy borrowers and lenders on the basis of their risk appetite. In this Liquiloans review, we will explore how the platform has skin in the game model, which creates alignment of interest of the platform with investors. Indians have traditionally been fixed income-oriented investors, where nearly 70% of financial savings are held in fixed income instruments. In the current low-yield regime, most bank saving accounts are only offering 2.5 to 3.5%. Liquiloans provides an innovative solution through which investors can get 8 to 10% returns on their money with instant liquidity and utmost consistency. It is thus a great product for parking short-term funds instead of liquid funds, saving accounts, FDS. When investors park money in liquid fund or banks, they are indirectly exposed to the credit risk of corporate borrowers. Using Liquiloans, people can directly take exposure to a pool of prime retail borrowers AVG. Credit score of 700 plus to earn higher yields. Retail loans have a lower default rate compared to corporate debt. What is Liquiloans' business model? Liquiloans is focused on salaried class, high-quality prime borrowers with low average ticket sizes. The platform does not charge any fees to investors or borrowers, as the cost is passed to the partners through which loans are sourced. There are 3 segments that it targets for lending: education sector, healthcare, home decor. It is focusing mainly on niche segments having perennial demand, which have a very strong end-user case and lower chances of default. Funds get dispersed directly to the dealer and not to the borrower. The main attributes of the sourcing strategy are zero-cost EMI loans. No interest is charged to the customer. Income is earned from the dealer's margin through subvention, rather than paying the complete amount upfront. The customer can repay over an average of 6 to 12 months without any additional cost. Strong customer profiles. Through tie-ups, the platform can attract high-quality borrowers with average annual incomes exceeding Rs. 8 lakhs. These borrowers are not credit-hungry, have a strong intent and high capability of repaying the loans. Underwriting advantage. Getting borrowers from dealer tie-ups gives the platform better insights for underwriting and selecting borrowers. Hence, they can assign weights to demographics, end-use cases, past repayment history, and accordingly rate the borrowers. Defined end use. As the end use of funds is strictly defined, borrowers with a malified intent are automatically filtered out, reducing the risk of default significantly. In fact, Liquiloans was the only P2P in the COVID lockdown which was able to deliver returns. Liquiloans founding team. Liquiloans is founded by Achal Mittal and Gautam Adukia, who have previously co-founded a successful rental platform Rentamojo. The company is funded by Matrix Partners, which has invested in some of the marquee companies like Ola Cabs, Practo, Quicker, and Cloud9. Other investors include promoters of Cred and Famicare. What are the alternatives of Liquiloans? Few P2P platforms provide unsecured loans but do not have the same model which is operated by Liquiloans. In the low-risk space, Liquiloans is one-of-a-kind product. Lendbox per annum is one product that you can add for instant liquidity along with Liquiloans. People who are interested in higher yield can also add platforms like Grip Invest, Trade Cred, and Clubwork to diversify into other alternative assets. Now let's have a look at my portfolio.
I'll show you the Liquiloans dashboard and the process to invest on Liquiloans, and I'll also show you my portfolio on Liquiloans, how I invested and how it is performing right now. So basically, once you log in, you can see 4 tabs. One is the dashboard, one is transact, one is my portfolio, and the next is my profile. You have to choose a plan depending on your expectations of interest and of your holding period. For instance, there are various holding periods listed on the platform, from 0-month holding period to 36-month holding period. So let's say if you select 36-month holding period, you will see you get a 10% IRR, while for a 12-month holding period, the IRR goes down to 9.25%. Depending on how much you want to lock in your capital, you can choose the plan. Second thing is, there are certain plans which have a higher lock-in, but they also allow you to withdraw early. So it's like breaking your FD. So if you take a 36-month plan which gives you 9% IRR if you lock it till 36 months, but if you take out the capital before 36 months, you will be penalized and you will get a smaller amount of return on your capital. So this is for people who want to lock it in for a longer time but are also unsure that there might be some event in the future where they might have to take out the money. So it makes sense for those investors. Once you have decided which scheme you want to choose, you can choose the amount, and then pretty much simple. Then you just have to click on invest now, and it will take you to the page where you have to use a UPI or debit card. I've selected that option. Otherwise, you can select the net banking option also. Then portfolio, once you have invested, it generally takes 1 day to reflect on your dashboard. So this is the portfolio. You can see I invested around 3.5 lakhs and got some 5,000 interest, which is about 1.33% on the capital, because XRR is 8.8% for this product which I had selected. It gives you the daily capital amount of money that you have gained on your portfolio. So it's showing capitalized interest, accrued interest. Then if you want to see your portfolio, where all you have invested, so that is also you can see on this platform. You go to my portfolio and show, so you can see this is your portfolio breakdown. So for my portfolio, I invested across 701 people, and you can also see the average tenure of loans is 5 months for these borrowers. Average credit bureau score is 776 and average borrower age is 35. So average amount lent out is 437. This shows the level of granularity in your portfolio, which is very good, because you don't want a large amount of money to be given to one person, which means that there's a huge concentration risk. If that person defaults, no matter how well the other part of your portfolio does, you will be in loss. You can it shows where all the money has gone. So it has gone to Baiju and some other companies. Borrowers who have used this money to pay to these companies, in some form or fashion. So that you can see it's an education loan or the healthcare loan. Yeah, it's mostly education and healthcare for me. So see that there's a defined end goal for all the lending the platform has done. So which makes it much better than a lot of other platforms which gives money for things like purchasing goods.
You can read the full blog on this topic by using the link provided in the description. That's it for this video. If you enjoyed it, then hit the subscribe button and turn on the notification for future video updates. Also, share your reviews in the comment section. See you in the next video. Till then, bye bye.